Welcome to The Explainer. Today, we're going to decode a market strategy that's over a century old but somehow feels more relevant than ever in our crazy algorithmic world. It's called the Wyckoff Method, and it's all about getting inside the heads of the market's biggest players.
All right, here's how we're going to break it all down. First up, we'll meet the mastermind behind the curtain, the Composite Man. Then, we'll learn the 3 fundamental laws he plays by. After that, we'll map out the market's 4 seasons and learn how to spot the key moves. We'll wrap it up with a 5-step trading approach you can actually use. And finally, ask the big question, why does this old-school playbook still crush it today?
Okay, so to really get a grip on the Wyckoff method, you first have to understand who you're actually up against. And here's the twist. According to Wyckoff, it's not a chaotic crowd. It's a single, very calculating player.
You know that feeling, right? Well, Richard Wyckoff, a Wall Street pioneer way back in the early 1900s, he basically said, you're right, it is. But he believed it wasn't just rigged, it was a game with rules, and if you were smart, you could learn those rules and play right alongside the people running the show.
So he introduced this really powerful idea. He told people to stop looking at the market as this chaotic mess of millions of individuals. Instead, he said, you need to see all of its movements as the deliberate, planned actions of one single entity.
And this Composite Man was his name for what we call smart money today. You know, the big institutions, the hedge funds, the major players. Their game plan? Well, it's brutally simple. They work to manipulate public emotion so they can buy assets from you when you're scared and sell them back to you at a massive profit when you get greedy.
But Wyckoff didn't just point out this master player. He gave us their rulebook. He figured out that their entire game is governed by 3 fundamental, almost unbreakable laws.
Law number 1 is the engine behind absolutely everything, the one we all kind of know, supply and demand. It's the core of it all. When more people want to buy something than sell it, the price has to go up. And when more people are trying to sell than buy, the price goes down. Simple, yeah, but it's the foundation for everything else.
Now, law number 2 is cause and effect, and this one is huge. It basically tells us that big, explosive price moves don't just appear out of thin air. They're the result of energy that gets built up over time. So that long, boring sideways period on a chart, that's the cause. And the longer that cause, the bigger the eventual trend, the effect, is going to be. It's just like coiling a spring tighter and tighter.
And law number 3, effort versus result, this is like your secret weapon for spotting when a trend might be ending. It's all about comparing the trading volume, that's the effort, to the actual price movement, the result. Think about it. If there's a ton of effort, a huge amount of volume, but the price barely moves, that's a massive red flag that the trend is running out of steam and a reversal could be right around the corner.
Now, these 3 laws, they don't just happen randomly. They play out across a predictable, repeating, 4-phase cycle. This is the game board itself. Wyckoff saw the market moving through 4 distinct seasons. It starts with accumulation, which is where the smart money is quietly buying everything up. That builds into the markup phase. That's the big public uptrend. At the very top, we hit distribution, where smart money starts selling. And of course, that leads directly to the markdown, the downtrend. And then, the cycle just starts all over again.
But here's where it gets really powerful. The 2 most critical phases, accumulation and distribution, are almost completely driven by public emotion. Accumulation happens after a big crash, when the headlines are terrible and everyone is scared or just bored with the market. That's when smart money buys. And distribution? It's the exact opposite. It happens after a massive rally, when everyone's euphoric and feels like a genius. That's when smart money sells everything they bought to you.
Okay, so that's the theory. But the million-dollar question is, how do you actually spot these phases as they're happening? Well, you have to learn to recognize the Composite Man's signature plays.
So during accumulation, here's what to look for. First, you'll see a big downtrend start to run out of steam. Then, bam, you get a massive spike in selling volume, what Wyckoff called the selling climax. That's the public finally giving up and panic selling. After that, the price just settles into a boring sideways range, while the smart money quietly soaks up all those shares.
And the grand finale of this whole phase is often a move called the spring. Oh, and it's a devious trap. The price will suddenly plunge right below the support of that trading range, tricking everyone into thinking the crash is back on. But it's a fake-out, a final shakeout designed to grab the shares from the last few sellers before the real rocket launch begins. Now, just flip that whole picture upside down, and you have distribution. It's the perfect mirror image. The big uptrend starts to slow down, then you get a buying climax, a huge explosion of volume as the public piles in, overcome with FOMO. Then a new trading range forms at the top, and this is where smart money starts unloading all their positions to that very optimistic crowd. And of course, there's a final trap here too. It's called the Upthrust, and it's a classic bull trap. The price spikes above the top of the range, making it look like the next leg up is starting. It's the final lure to suck in the most eager buyers right before the Composite Man pulls the rug and the markdown starts.
All right, so we have all this incredible theory, but how do we actually turn it into a practical trading plan? Well, Wyckoff didn't leave us hanging. He laid out a very clear 5-step approach.
He gave us this really simple playbook. Step 1, first, figure out the trend of the overall market. Are we generally going up or down? Step 2, find stocks that are moving in harmony with that trend. Don't fight the tide. Step 3, make sure you've identified a cause, a good, solid accumulation or distribution phase that's big enough to produce the move you want. Step 4, look for that trigger, like a spring or an upthrust, that signals the stock is ready to go. And finally, step 5, time your actual entry with a move in the broader market for that extra tailwind.
So, you might be thinking, okay, this is all cool, but this guy was trading 100 years ago. Why on earth are we still talking about this in an age of supercomputers and algorithms? It's a fair question.
Look, let's be real, this method isn't some magic bullet. It's complex, it can be subjective, and it requires a ton of patience. You can't just turn it into a simple buy-sell indicator. But its advantages are profound. It gives you a deep, structural understanding of how any market works because it's focused on the timeless patterns of institutional behavior.
And that really gets to the heart of it. The reason the Wyckoff method is still so powerful today is because it's not based on some technical indicator that can get outdated. It's based on the one thing in the market that never, ever changes: human nature. The game, at its core, is always driven by the same fear and greed that fuel supply and demand.
So I'll leave you with this final thought. Wyckoff offers more than just a trading strategy. It really offers a new way of seeing. It's a lens that can help you look at any price chart, and instead of seeing just random, chaotic noise, you can start to see a story, a game with clear players, rules, and predictable moves, just waiting for you to read it.